The deck that I have prepared for you tonight, I'll be honest with you, is the one that I traditionally give to small businesses across America. And what I mean by that is we work with the small business development centers, chambers of commerce, etc., other software providers like Palo Alto Software, Constant Contact, Intuit, working with small businesses around the country. The reason I want to state that and put a pause is I realize that I'm in Sunnyvale. I have connected with a few of you before this began, and I realize that for many of you, it's not about establishing a bike shop or a cupcake company or whatever, but more of a venture-style business. And the reason I want to point that out is I've been part of my company from pre-A round to we're about to close our B round this week. And so I've got pretty decent experience when it comes to raising money on Sand Hill Road. So now I would obviously not pursue this line of discussion if I were in Omaha or Charlotte or whatever it might be, but I realize where I am and I realize the audience in front of me. So I want to be very clear that what I'm going to go over tonight is both a mix of what we would traditionally talk to for small businesses, traditional small businesses, but for those of you in the audience who are more of a tech business, please feel free to stop me at any point, and I am more than happy to provide that sort of specific, perspective based on where we are and what we're all trying to do. So, the first thing now that I would begin with is if you are a small business in America, and this is probably the biggest aha moment we have, and frankly how we ultimately raised our A round, was that if you're a small business in America, you have a credit score, just like you have a personal credit score. If you ask any American, they say, what's your credit score? 800, 700, 650. The vast majority of small businesses in America don't realize that their business, that bike shop, that florist, that auto mechanic, actually has a score for that business that is somewhat separated from themselves. And really, that's one of the most important things as an early entrepreneur that you should understand. So why does that matter? It matters for a variety of reasons that we're going to talk about tonight. But perhaps most importantly is that once you separate your personal life from your business life, you can raise more money and at better rates. I realize that's not exactly what it says behind me, but that's ultimately what it all boils down to, right? The sooner that you can separate your personal guarantee from the business that you operate, the better off you will be. You will get more money at a better rate and at a lower risk profile than you could personally. And that should ultimately be your objective. So let's talk about the background. So do these names behind me register for you at all? And the reason I say that is because I've been doing this now for over a year, and so these things seem obvious to me, but maybe they're not. So Experian, FICO, Dun & Bradstreet, you might have heard about these. So let me give you a very high-level tutorial about what these bureaus are, what they do, what they don't do, and how it all works together. So first of all, let's talk about personal. All of us in here, with 99% confidence, have a personal credit score, okay? And there are 3 agencies that provide these: TransUnion, Experian, and Equifax. I look by mine. So those 3. Now here's the thing. There's 97% overlap in any of those scores. And they all seek to predict the same thing, which is what is the likelihood that you're going to default on a payment in the next year by 90 days, okay? So all three of those, and it's also a 300 to 350 to 850 score. The chances that any of you in here have a score on those three where one is dramatically different than the other is highly unlikely, okay? They use the same information, they're looking at the same thing. So if you have a 750 on one, chances are you're within 10 or 15 points of the others. Now on the business side, there is Experian, which also has a personal score. And there's Dun & Bradstreet, which only has a business score. And there's also Equifax that also has a business score. Now these look at different things, which we'll talk about in a bit. Before we do that though, let me talk about FICO versus FACO. Has anyone heard that distinction? Like a FICO score or a FACO score? Okay, so FICO, which stands for Fair Isaac Corporation, is a group of, it's a corporation based on folks who do statistical analysis on information. And these bureaus, Experian or Equifax, collect data on us, right? Your payment, whatever. They send that to FICO. FICO develops a score that ultimately determines in their risk profile how likely you are to default on a payment on 90 days within the next year or so. That's your FICO score. So in case I've ever gone in for a mortgage or something like that, a car loan, that's your FICO score. What ultimately happened, Experian and the other bureaus who provide the information to FICO said, well, why are we giving them all the information, allowing them to come up with a score? Why don't we determine our own score so we can kind of cut out this other group? Basically what they did is they re-engineered what FICO had been doing, came up with a score that was almost the same thing. So they re-engineered what FICO had been doing, and they presented it. Now, if you ever hear, that's not a FICO, that's a FACO. It's basically what Experian or TransUnion has taken with their own data and has re-engineered what FICO would do with it to come up with a score. Now, in our opinion, if FICO is going to give you a 710 and Experian and TransUnion determines you're a 700 or whatever, it's essentially all the same thing, but that's the FICO and FACO. And the reason I say that is because it's not necessarily clear, particularly in my own experience when I joined this company, the complexities of the credit industry. Now let's talk about the difference between personal and business credit. So on the personal side, like I said before, TransUnion, Experian, there's also Equifax. They're all basically the same thing, right? Up to 850. If you are 750 and higher, you're excellent, or 800 and higher. And by the way, some people try to say, oh, I'm going to get you to 850. The difference between an 800 and 850 personal score is 0. It's levels, right? If you're above this level, I don't care if you're here or here, whether it's your auto loan company or your mortgage qualifier, it's all the same thing. And on the personal side, they're all looking at the same thing, right? Which is you as a personal consumer, what is the likelihood that you're going to default over 90 days in the next year, okay? So on the personal side, they're all the same thing, same score. Let's talk about on the business side. So you're going to start a small business. There's your Experian IntelliScore, D&B Paydex, let's call FICO SPSS. On the business side, they have different scores, typically 0 to 100, sometimes 0 to 300, and they look at different things. So I'll give you my favorite example, difference between Experian and D&B. Let's just say you are a new restaurant here in Sunnyvale. You're a Mexican restaurant. You just started, you're about a year old, and you attended this lecture, and you understand how credit bureaus look at you. So you went out and you made sure that you got a bunch of trade lines reporting. So people, your suppliers, whether it was, whatever, your food suppliers or whatever, people are reporting against you. you're paying on time or ahead of time. You're paying your rent on time or ahead of time. And now you're 1 year in. You're going to look at your score. Now, your personal score, if you're Joe Blow, again, TransUnion, Experian, Equifax is probably all going to be the same. But if you look at your business score between Experian and DB, chances are they're going to be different. So Dun & Bradstreet Paydex, which is often used for commercial terms, is rearward looking. And what I mean by that is it is a historical view of how you pay your bills. So in order to get a D&B score at all, you have to have at least 4 trade lines reporting, which it means at least 4 companies are saying, you know, this person's paying their bills, whether it's, again, to go back to the, the restaurant, your soda, your ice, whatever the case might be. And if you pay them on time or ahead of time, you get a really good score. So let's just say you've got 4 or 5 folks that you're paying and you're doing a great job and you're paying ahead of time. You might have an 80 or 90 high score on Paydex. Now, IntelliScore from Experian is a mix of backward looking in terms of what you've paid, as well as prospective. What is the likelihood you're going to default? So in this case, if you're a new restaurant, that's a pretty high risk business. So even though you have a great track record of paying many people on time or ahead of time, the fact that you are a restaurant and you are less than 2 years old gives you a high risk profile. So you might have an Experian score of 50, right? So depending on your financial situation in terms of what it is you're looking to do, different folks are going to look at different scores. So you might have a perfect score on D&B and you might have a very average or mixed score on Experian. But again, that's all about your industry, your time in business, and what it is you're trying to do. FICO SBSS, and let me just pause on this real quick before we go, is a score that the government came up with for SBA loans. Who here knows what an SBA loan is? All right, number of hands. Real high level, the United States government, if you qualify, will back up to 80% of your loan with your financial institution. Now, they're not going to back up your money 80%, they're going to back up the bank's 80%. But the bottom line is, if you qualify for an SBA loan, the government will back $80,000 of a $100,000 loan. Now, as you can imagine, banks love that loan, right? Because they've got very little to lose. This FICO SBSS score is what the government ultimately determined they want to use to fast track loans. It's a combination of your personal and business scores. For the most part, you need over a 160 out of 300 to qualify, as low as 140 depending on extenuating circumstances, but I would say 160 or higher and you're in pretty good shape. So again, business or personal, very straightforward. Business, a little bit more complex. So how are these scores ultimately populated? Even if you are relatively new to business, there's a very good chance that the business bureaus have a profile about you. You go and you register your business. There's some public records. You pay some people. Even if you do nothing, the bureaus will ultimately figure out you have a restaurant, you have a massage service, you have whatever it might be. It's out there, but the reality is it's probably a thin file, okay? So once you register and you have an existing business account, you can rest assured that the bureaus will ultimately know where you are. So once they have that information, how do they ultimately determine your credit worthiness? It's a variety of things. Your debt to income ratio, perhaps most important is your payment history. Do you pay on time or ahead of time? Any question?
When it came to the FICO score, you talked about something called the SPA loan.
Yes.
Or can you just repeat that part as to how you can qualify for SPA loan?
Sure.
Is it anyways good for you, or is it only good for the bank?
Well, it's very good for you. So thank you very much. So the question was regard to the Small Business Administration loans. So the United States government has a big pool of money that is all about helping small businesses grow and succeed. The Small Business Administration. As a matter of fact, this week, up in the city is the Small Business Development Centers Association's conference for the year. And their primary objective is to help small businesses get access to these SBA loans. So on the one hand, yes, the banks like these loans because the government backs 80% of them. However, from a small business perspective, you like it because the banks will often give them to you just about a point or two over prime and usually about a 10-year payback, right? So $100,000, a couple points over prime, it's a very affordable way for you to finance your business. It's called the 7A loan. You can do up to $350,000, which, by the way, is what the government absolutely wants to do. Many of the banks, so here's the issue now. I'm going to kind of tell you a little bit about how the banks look at it versus how the government wants things to be done. The amount of effort it takes for, let's just say, Wells Fargo to ultimately underwrite a loan for $250,000 is the same effort, time, and money that it would cost them to underwrite a loan for $5 million, right? Now they're going to make a certain percentage on each of these. So as you might imagine, Wells Fargo, U.S. Bank, Chase, they want to do more and more of the bigger loans, right? Because it's easier, they reduce their risk, and they make more money. Now, Uncle Sam, what they want is more and more of the 350 and under because that's going to get to more businesses. I mean, what kind of typical mom and pop small business is going to raise a $5 million capital loan, right? So the government absolutely wants to do 350, 250, 150, 100 type of loans. That's what they're pushing. The banks are a little bit reluctant to do that, again, because the amount of effort and time and risk is equivalent to the 5 million, but that's what the government wants, for sure. And so your question, which is, yes, the banks have value in it because the government's backing it, but as a small business, you also want to do it because it's the best possible terms you can get. It's a couple points over prime, and usually it's over 10 years. So it's about the best money you can get as a classic small business. Now you also have to qualify in terms of your industry, your time in business, and a couple of other things. But in terms of our product actually will help you figure out whether or not you qualify for that. But if you're a basic small business, that would be your first stop.
Most of us are startups in this room. Aren't startups far too risky for an SBA loan and to even be considered for that?
So, great question. So, and as I mentioned at the beginning of my talk, I realize I'm not in Tacoma. This is Sunnyvale, and you guys are startups. So the question was, aren't basic startups far too risky for a bank loan? Short answer, yes, right? If you go into your typical bank, certainly a Citi or Wells, and say, I got a great idea, Snapchat or whatever, you're never going to get that kind of money from a bank. The kind of money that they're looking to raise from a typical small business bank is going to be a bit more of a restaurant, or obviously a dentist or a doctor or something like that. We can talk a little bit about raising venture capital, seed round, an A round. As I mentioned, perhaps before the film started rolling, I joined my company at the A round. We were funded by Kleiner Perkins, a $6.5 million round at 20 million post. I came in as a 6-figure investor in our A round. I was actually on the investor side of the table before Kleiner invested. I was at Intuit before this company. I spent 7 years there. And the whole experience of raising money in VC is obviously very different than raising money if you're an established restaurant or bike shop or whatever the case might be. And again, during the Q&A, I'm happy to take those questions in terms of the way I look at it is sort of the objections you have to overcome with the A and the B and the C rounds. I'm not even going to touch seed, because I think seed is friends and family, and it's just people who have to believe in you and who are like, you know, I'm going to give you $10, $50, $100,000 to get this started, and there's nothing I can tell you that's going to change, you know, what they call friends, family, and fools to make that investment. But if you want to talk about what it takes to get an A round investment from a top tier venture, I'm happy to talk about that. So once it comes to being a small business, do you have a thin file? And that is, it's often very common if you're a small business that the bureaus know that you're out there, they have you on record, but they don't have enough information to actually have a score on you, right? And so with that, let's also talk about the differences between your personal and business scores. And we already touched on a few of them. So differences scores, we talked about that. Number 2, and this is one of my favorites, there is no FCRA protection for a business credit score. So FCRA, Federal or Fair Credit Reporting Act. So this came out as a personal credit profile. You have certain rights. I cannot look up Ritesh's personal credit score, right? There's only 9 what they call permissible purposes for me to get his credit score. And for each of them, he has to voluntarily and explicitly give me authority to do that. Car loan, mortgage, credit card, etc. Right? But the bottom line is I can't be like, hey, I'm really interested in what Ritesh Gupta's personal credit score is. Protected. Now, we have Aniket over here. And he's got Aniket's bike shop. Business score. I can look up his business score anytime, for any reason, anonymously, without him knowing. Okay? So your personal score is protected from legislatively. Your business score, it's the Wild West. Douglas.
How do they look it up? Not on the web.
So the question was, well, how would they look it up? It's not on the web. You can go to D&B. You can go to Experian. The company I work for, Creditera, one of our packages, we allow you to look up at least 5 other businesses a month, every month, right? All you need is business name, address, and telephone number. Let me give you an example of how this might be used. My brother-in-law lives in Pittsburgh. He has a bottled water company. Literally just him and, you know, my sister and niece and nephew. And a guy came to him, and he was using Creditera basically because, you know, he's my brother-in-law, so he has to. And a guy came to him and said, I want to, you know, hire you guys to give me bottled water. I've got 6 locations around Pittsburgh, but I want 90-day payment terms, which means my brother-in-law has to drive all around Pittsburgh, right? 6 different locations for 3 different months, getting nothing, right? But what he was able to do with our product was look this guy up, IntelliScore and D&B anonymously, and it turns out this guy's got perfect payment, right? Never missed a payment on anything. So for my brother-in-law, that was him going, all right, you know what? That's good enough for me. So even though I gotta take it in the hole for 3 months, that gives me confidence. So that's a big part of kind of what we do, and also how small businesses think about it.
So I have a question. So here we're trying to differentiate between a personal and a business.
Yep.
What about businesses which are like sole proprietorship or LLC, where the person is also the business person, the owner?
Yep.
So then, how do you distinguish between the credit rating for each one of them?
Yeah. So great question. And so to repeat, the main question was, how do you separate between a personal and business, particularly when it's an LLC? So here's the thing. For those of you who are in classic small businesses, and so again, I'm going to slice off those of you who are Silicon Valley tech startups. But if you are a classic small business, here's the reality. Your personal credit score is going to matter a lot, and it will continue to matter a lot until your business has probably been around for 5+ years and has over $1 million or $2 million in revenue. Okay? So, I mean, I could draw you what we kind of think of as this various curves, but the reality is, if you're an LLC, when you start out, your personal business or your personal credit is going to count for everything. Even if you do everything right and establish your business credit over time, it's going to take several years and again, several $1 million in demonstrable revenue for you to move away from a personal guarantee on that business. So it was what it is. Asaf.
If you're just registering your company, does it have any impact if you register as an LLC or, say, an S corp for when it comes to establishing business credit?
Certainly not early on. So the question was in terms of the impacts on your credit depending on how you establish your business, whether it's LLC or S corp. Again, early on, it's going to be ultimately back to you until you can demonstrate that your business is standing on its 2 feet. Kim.
So is Creditera, oh, I'm sorry, thank you. Yes, is Creditera, is it a startup?
So our company, the company I work for, is very much a startup. So I'll give you the 90-second overview. So the company was founded in Salt Lake City a few years ago. Our founder, actually the co-founders, were all small business owners themselves. So our CEO owned a electric, sort of a neon lighting, awning, and sort of electric light company in Idaho. And that's when he first learned about the importance of small business credit. I'll give you 2 quick anecdotes from that I think are very illustrative. Number one is he put a bid in on a big project for an automobile service or sales company like a Ford or whatever, and it was a $250,000 contract, and his competitor put his bid in and then put Levi, our founder's business credit rating in there because, again, he could look it up anonymously, et cetera, and it wasn't very good. So that was his way of showing the client that, do you really want to trust this guy with the business? And then number 2, he had been renting a lift to put in electric signs about 2 or 3 times a month, and he realized that he was paying more in rental fees than if he had just bought the lift, right? So we did the math and realized that he could do it, but when he went in for the equipment lease, they denied him, and again, because of business credit. And so for him, this was his way of waking up going, there has to be a big opportunity here, right? Because I've got this business, I know it can work, I'm being denied things that I know I shouldn't be denied. And that was sort of the germ for the business. That being said, we raised money about a year ago from Kleiner Perkins. To be perfectly honest, there was a company called Credit Karma, which is for personal use, consumer use. You go in there, they give you your personal credit score, they help you figure out what's the best credit card for you. And in many ways, we're kind of like that for small businesses because we give you your personal credit score as well as your business credit score, Experian, Dun & Bradstreet, as well as the SBSS liquid credit score, and we help you figure out what's your best option. And so we're very much a startup. We have about 45 employees. Most of them are in Salt Lake City. A handful are here in San Mateo. Myself, the CEO, the Chief Marketing Officer, and a few other marketing folks.
So you're a credit score company. You're not lending money. You're
So
not a
we are
lender.
not a credit score company, but we are also not lending. So first of all, we're not a lender.
Okay.
We're not credit repair.
Okay.
And we're not a credit bureau. So we've established relationship with the credit bureaus. So we suck in your data through APIs. So we have TransUnion and Experian on the personal side, Experian, Dun & Bradstreet, and SBSS on the business side. We're in the final negotiations with Equifax on both sides, and we just pull that data in. We've pulled, we've got contracts with those bureaus where we pay a certain amount, so we can pull that data in. We pay it on your behalf. We show it to you, and then we also kind of surround that with additional information and data to help you basically understand what that data means and what you can do to improve it.
Okay. You don't hook us up with the lender.
We do,
Okay.
actually. So part of our business model, we have a dual-pronged business model. One is we do sell you your full reports, which we charge between $30 and $50 a month, which we take a certain percentage of. But our core value is now that we know your personal and your business credit scores, we're able to tell you this is your best bet in terms of financing, right? So we're not going to show you something that you're not going to be approved for. And we're not going to show you something for which you can do better than. So if you're not going to get approved for an SBA loan, but you can do better than a merchant cash advance, we're just going to show you, let's just say, Funding Circle, and say this is probably your best bet. So basically what we do is we take the guesswork out of it and the search out of it for you, so that when we offer you up a financing option, because we know your personal and your business scores, this is most likely what you're going to qualify for.
So do you have an app like Credit Karma, or are you planning one, or is it subscription-based altogether?
So the question was, do we have an app like Credit Karma? And the short answer there is yes. You can go to our website, creditterra.com, if you want to sign up. It's free, no credit card required. We do ask you some personal information, including your social security number, which Credit Karma would do as well, because that's what's required to pull your personal credit score. I must stress that if we pull your personal score, it's what's called the soft pull, so it will not count as an inquiry against you. Some people are worried about, well, if you pull my credit score, is that going to hurt my credit score? This will not. We have an app on both Android and iOS, so you can actually sign up on the phone as well. And if you are brand new to business, I would say stick with the free product. You have no real reason to get our paid product, which is your full business score. But if you've been around for a while, 3 to 5 years, and particularly if we tell you that you have sort of poor, because what we can tell you for free is what your business scores are at a high level, like a grade. We'll give you a B or a C or an F. And if you have a really low grade on on the business side of things, it's probably worth your while to pay the money to figure out what's going on your business side. Brian.
Oops, I had a question.
Oh, I'm sorry. Go ahead.
So I just wanted to understand more about your services. Do you only introduce us, like once you tell us our score or whatever, to loan options, or also like other types of access to capital?
So the key point there is, in terms of our service, we don't sell your information at all. So it's not like if you sign up, people are going to start calling you. It's all about what it is that you want to do. Our platform goes everywhere from SBA loans, which is like SmartBiz, Celtic Bank, all the way down to Kiva Zip and Opportunity Fund, which are people who require basically no credit scores. So you have the complete spectrum. That being said, we've been talking to heard you talking about Indiegogo and others who might make investments. We don't have them on our platforms now, but for the most part, it's your traditional investment site. So it's not VC, it's not that kind of high risk ventures. I'm sorry, Brian?
Back to Silicon Valley. Do venture capitalists look at personal and business credit? And also, question two, if you're going to sell the company to a buyer, do they look at personal and business credit at the acquisition stage?
So the question was, do VCs look at personal and business credit and would acquirers? My response to that's going to be a little of yes and no, but leaning on the no. So if you have a really good idea and you want to raise an A round, they're not going to be terribly concerned with your personal credit or your background. However, they will look at it, okay? So you guys have all heard of the term due diligence, right? VC firms are not going to write you a check for $7 million just because you're a really interesting person, right? Now, you might get to that final stage before they write it when you come in. And so on an A round, and again, let's talk now about what it takes to make A round financing. What you need to get A round financing today, and this is a great environment, is just a really great narrative, right? You come in, this is the problem, this is what we see as the solution, here is my PowerPoint vaporware of what it would look like, here are the reasons to believe that I and the people that I've brought in can create this solution, here's the prototype, etc., and I want to raise $5 or $6 million bucks. Okay, that might be good enough for you to get to the final investment stage. You know, even the investor stage of the VC. Even after you get past that point, they're going to do their due diligence. Okay, they're going to pull your credit report, they're going to pull your criminal record, they're going to do everything. Okay, and oh, by the way, if you have a DUI, if you did something silly, they understand that. Many of them are like, we understand that entrepreneurs are risk takers, so don't think that because you did something kind of silly. And in my case, our founder got arrested because he was driving 130 miles an hour through Wyoming, right? You know, it is what it is, and he was upfront about it. I mean, if it turns out you got arrested because you were money laundering, you know, that might be a different story. But, you know, the VCs are absolutely going to look at your background, but it's going to be the last thing they do. It's not going to be the first thing they do. If you're looking to raise money from a traditional financial institution, a bank, you know, whatever, you're a basic small business, it's going to be the first thing they do. It's the gate, okay? It's not even going to mean that you're guaranteed to get it, but the first thing they're going to do is this person reliable? Can I trust this person? It's the first thing they're going to do. On the VC side, it's going to be the last thing they do. Let me quickly give a couple more points between personal and business credit because I think they're really important. One of the most important, which is not behind me, is the difference between demographics and firmographics. So on the personal credit side, there are no demographics considered. So all of us in here have a credit score. Our age, our race, our income, our employment is not considered at all. Even if you are skeptical on that, I can assure you, it is not considered. You might make $800,000 a year or $50,000 a year. It is not considered in your personal credit score. It is the exact opposite on your business score. How long have you been in business? What industry are you in? How much do you make? All of that stuff is a critical component to how they determine what your business credit score is. So as much as your personal credit, again, regulated by the government, is very much demography blind, your business score, completely unregulated, is wide open. years in business, industry, revenue, all of that kind of stuff is how your score is made. I'd also say all credit reports have errors. Business have even more than personal. You'd be surprised how many folks will look up their business credit reports and find out that their SIC code for their industry is wildly inaccurate. That could be huge. Because if you're miscategorized, I'll give you an example. A friend of mine owns a bar in Burlingame. It's called the Barrel House. He signed up for our company and found out that the business credit bureaus had him as a barrel maker. Turns out that actually a barrel maker is a pretty good thing to be in. It's actually a low-risk company as opposed to a bar. But you'd find that that's not at all uncommon, right? That your SIC code, it's completely automated, generated automatically, and it may not be correct. So definitely take that look. And the last thing I would say is in terms of payments. So all of us as consumers, we can pay up to 30 days late on our credit card, our car payments, whatever, and we're still on time. 30 days past due, and we're good. If you're a business, if you pay 1 day late, you're in arrears. If you pay on time, you're just okay. And if you want a perfect score, you got to pay ahead of time. So again, a difference between personal and business. Mike Mitchell.
Where do they get the revenue information to put into the report?
So they will pull that in from a variety of different records. It is most likely wildly inaccurate and a guesstimate. Most folks will have actually nothing on that point. When it comes to raising money through a financial institution, your bank balances will be incredibly important. And this is the other thing that's really important for all of you to understand. You might have QuickBooks, you might have Xero, which, by the way, I hope you all do to manage your books, although hopefully QuickBooks, because I spent 7 years with them, I still own stock. That is considered less confidently than your your tax statements. So if you want to understand how the bank looks and judges in terms of how much your business actually made, it's going to be your tax returns. So that's going to be how the bank determines ultimately what that revenue is. So D&B might have a score on you in terms of what they estimate your revenues are. The banks might give some credence to that, but at the end of the day, it's going to be your tax returns in terms of how they determine it.
How do they can't get a hold of tax returns?
Well, you're going to have to if you want the loan.
But Dun & Bradstreet doesn't get the tax return.
No, they don't. Absolutely not. So if you want to think about how the banks look at D&B and Experian, it's that gateway, right? If you've got a crappy score, and it may be wrong, but they're going to be like, we're not going to spend any more time with you. If you've got a good score and some good stuff, it's not a guarantee. It just means that you're going to go in and now they're going to do the full underwriting on you. Make sense?
Can you tell a little more about difference between your service and D&B? How do you help people fix their credit? So I understand you collect certain data. How do you collect the data? Who do you provide it to? Who's looking at you right now?
Right.
Because
So
everybody's looking at D&B. They're like official record.
Right.
How do
so the question is, how do we differ between D&B and others? So I would say the main difference is we're not a bureau. We're not credit repair. What we try and do is help you, the small business owner, understand how the outside world looks at you. So when that person at US Bank or Wells Fargo or Amex Open is going to look at you, we can help you understand this is what they're going to see, okay? It may be right, it may be wrong. If it's wrong, we want to help you ultimately figure out how to make that better. We're not credit repair, right? And we partner with D&B. Our company, we allow you to get a DUNS number for free. We allow you to dispute your DUNS report for free through them. But we don't charge you the price that they would pay to fix that report.
How about vendors and vendor contracts, and when people signing up to be a vendor to a big company?
Mm-hmm.
There is a requirement to
Yep.
be DNB, to have DNB number,
Yes.
and have certain level of information on DNB.
Correct.
And that's where the struggle starts, because you cannot get in there, you cannot fix anything, up to the point when you start paying $1,000 for their credit repair.
Yeah.
You cannot do anything about it. So can you help in this case?
Yeah, so the bottom line there is I feel your pain, right? So what she's saying is if you want to be a vendor for a large, let's just say a large retailer. And so
And
we
that's
actually,
relevant for startups, very relevant, because when
Yeah.
startups trying to sign their first contracts with big retailers,
yes,
that's where they stumble
yes.
right away.
So actually we have I won't do it here because I guess I can't, but we have a module in our product for free, our free product, which is called Credit Target. And if you want to go in, we have 8 of the most common scenarios that a small business might be looking to accomplish. It might be, I want a contract with a major retailer, which is what you're talking about. I want to get a contract with the US government. I want a equipment lease, whatever. So let's just say you pick, I want to get a contract with a major retailer. So I am a janitor and I want to get the contract with the local Walmart, right? On trade services, they look at D&B. So again, she brings up a great point, which is different people are going to look at different things depending on what you want to do. On the personal side, mortgage, car payment, credit card, they look at the same thing. On business, depending on what you do, they're going to look at different things. I want to get a contract with the government or Walmart, D&B. I want to get a business loan, Experian. I want to get an SBA small business back loan, SBSS liquid credit. So on the business side, they're going to look at different things. And our product, if you pick a target, let's just say large retailer, it'll dynamically tell you this is what you're going to need to do to achieve it, right? You're going to need a 70% on D&B, no extra payments, blah, 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 and we'll tell you basically how to get there, and it's free. So we don't ask for additional money. So again, our whole thing is education, helping you, the small business, understand how those people look at you, what scores they're looking at, what scores they want, and then what you would need to do to get those scores. Cool. Any other questions? And then I've already kind of hammered this point home.
Oh, sorry, Tim,
but-
quick. So how do we get started with you guys? Do we go online, or do you have a consultant that sits down with you and like
So
gets everything?
so the question is it online or handheld or et cetera? It's online. By the way, for those of you who are out there trying to raise venture capital money, you don't raise a lot of money if it's a handheld approach. Believe me when I tell you, you got to scale. You got to show people that you can service millions of small businesses. So ours is completely self-help. Sign up for free. However, we do have member services in Utah who can help, but it is not a consultative experience. This is really important, and it actually gets to her point in terms of small business credit. Like I said, personal, probably 3 reasons: home, car, credit card, for the most part. If you're in business credit card, business financing, we already talked about that. Your insurance rates will be determined by your business credit score. Equipment leasing, D&B, which you said, huge component of whether or not you can get that. Same thing with commercial real estate. Trade credit, am I going to pay 30, 60, or 90-day terms? What is your D&B score? You know, do you pay on time or not? Government and enterprise contracts. You want to deal with Walmart? You have to have a certain score. You want to contract with the US government? You got to get a certain score. A lot of these things small businesses don't realize, but this is how the world operates.
Question? So for a company who's really, really new in the business, they don't have a good rating. If you go back to the previous page.
Yep.
So who's score are they looking at? Is it the founders score? If there's three founders, do they go to their personal scores to determine
So they do. So actually, that's a very different question that you're asking. So bottom line, if you're brand new in your business, so let's just say it's you and your brother-in-law and your friend, right? You all have your personal scores, and then your business is going to have its own score. If you guys are brand new, you're probably not going to have much of these scores, so you're probably not going to qualify for anything here, pay the worst rates here, and so on. The broader question, though, is you're going to go in, and they're going to say, well, we're going to lend to you, but it's going to be based on your personal score. But now you got 3 people. And I'm going to hypothetically say you got an 800, a 750, and a 550, right? Somebody went through bankruptcy or got divorced or whatever the case, right? On all those 3, it's almost impossible to separate those out, and the bank's going to look at the worst score, for sure.
Unless he owns less than 20% of the company.
That's right. She said unless they own less than 20% of the company. But if it's a 50-50 and it's a huge percentage, they're going to look at that for absolute sure.
2 questions. The first one, you said about divorce affects your score, credit score.
I pulled that out. And divorce could impact your credit score depending on how it impacts.
And so basically, if I just came from Europe and decide whatever, I'm new to this country, I want to open a pasta bar,
Yeah.
Little restaurant. I don't have a credit score. I don't have anything. Does that mean that they basically will not let me lease any equipment or anything? So basically, it's almost
yes.
it's impossible to open
Yes.
a business.
That's right. So you're going to show up. If you're brand new to this country, you're going to be a ghost to the credit agencies. And if you're a ghost, that's not a good thing, which is you've got no credit score. So one of the things you might want to do, how long have you been here?
Few months, 2 or 3
Few
months.
okay. So at that point, it's going to be hard. I would say the first thing to do is just start building up credit of some kind, whether it's with a credit card or others. A company, and we don't have this now with my company, but an interesting service, and I say this because it particularly relates to people who are new to the country, is there's a country that can, for a fee, have your renters report to your TransUnion account for a good payment, and they can actually retroactively go back for 2 years. So, for instance, let's just say you came from Russia. You've been here for a few years. You do everything in cash. You've got no credit cards. And so now you want to go and do something, and you've got no credit. You're a ghost. There's a service where you can go and say, well, listen, I've been living here in Sunnyvale, been paying my $3,500 a month apartment, $2,000 a month apartment. You can pay, have that apartment company go and report your 2 years of payments to TransUnion on time, good faith, whatever, and basically within a month give you like a 650 credit score. So there's ways in which you can, if you're new to the country, figure out, even if it's cash payments, that you can build up a profile. But it's very important to kind of have that profile. Again, going back to my comment of demography blind, right? You could be making $800,000 a year here working for Google as senior vice president. If you show up and you've never had a credit card or anything here on TransUnion, you're a zero account, and it doesn't matter.
Isn't there some sort of cross-reporting with some European countries? I know that some high-end dealerships are able to pull credit report from countries like England and France and maybe some
That
of
could
the.
be. I
So
don't
you
know.
don't-
I
you-
don't know.
you don't
would
have
not
that-
comment.
So there is nothing in with your service that helps establish that.
Not that I know of.
Okay.
Although we have TransUnion Experian, and if they have it, we'll have it.
So
But-
you can help with that part, right? With the establishing personal credit
Yeah.
for newcomers.
Yes.
Okay, that's huge.
Helps. You know, the bottom line is that one of my favorite statistics. Actually, I'm gonna quiz the audience. What percentage of American GDP do you think is generated by American small businesses? The U.S. economy is like $13 trillion economy, obviously largest economy in the world. What percentage do you think of that economy is generated by small businesses? 90, 60. You're making me feel bad. It's 50%. You guys are saying 90%, so I was hoping you were going to say 20 or 30%, but it's 50%. How about new hires? What percentage of new hires do you think get hired by small businesses? Yeah, that's about 65, 70%, right? So American small businesses are really the backbone of the overall economy. And the majority of them fail to get the financing that they need. And many of them go out of business because they can't get that financing. And so that's a big part of why we're here and why we're trying to help small businesses grow. Sure.
So we've been mentioning the word small business.
Yep.
But we haven't really defined it. I mean, I know what it is, but in terms of revenue, how do you consider, what do you consider as a small business? This is the number of...
my own opinion, and you know, the government has their own. I'd like to think of small business as a classic Main Street business, right? Which is 1 or 2 locations, less than 10 employees, maybe less than 5 million in revenue. That's a huge component. And there's 30 million small businesses in America, but only 6 million have employees, right? So 24 million are just SOHOs, single owner, home operated, consultancies, what have you. You know, when I was at Intuit, we used to have what we used to call the thumbtack, right? Which was like by revenue, right? You'd have this huge base of numbers, but with little revenue. And then there would be this really small base of the mid-market that would maybe get up to 500 million, right? So, you know, your typical American small business, less than 10 employees, less than $1 million, probably less than 5 million revenue in terms of, you know, again, your classic Main Street business. The really most important thing for all of you, obviously those of you who have grand ambitions, but even though, or those of you who want to open up a restaurant or a cupcake shop or whatever, is that a typical small business can access 10 to 100 times more credit than a person can. So once you establish your small business as an ongoing concern that's profitable, you're going to be able to raise a heck of a lot more money through your banks and other financial services than you ever would from a personal guarantee. And we've also known from talking to the bureaus, because we have relationships with them, that once somebody has a business account, they lean on that business account 10x more than they ever lean on that personal account, that 650, 750, 850 score. So once they go and they've got that solid Experian or Dun & Bradstreet score, they're going to lean on it an awful lot. So protect yourself. What can you do? Figure out what your scores are. Sign up for Credit Terra. It's pretty easy. I'm not going to take any of your money. Make sure that you have incorporated your business, whether that is with LegalZoom or Ink for Free, whatever. Establish an employee ID number. All of this, by the way, you can do on our site for free. Make sure you open up a business bank account. Separate your personal from your business. Start establishing credit lines. One of the most important things you can do. I don't care if you're here tonight because you want to open up a cupcake shop and it's just an idea. You can go and start getting credit cards from Chevron, Home Depot, Office Depot, Staples. They will give you $100 or $200 in credit only for their stores, but they will report it against your business. So go out there, use it $50, $80 at a time, and you will start to build up credit against your business. Asaf.
I had a question about that. So doesn't that go against your personal, so you're personally guaranteeing that you repay your credit from Chevron or from Staples?
No. When you sign that up, again, they're only going to give you $100 or $200. It's nothing.
Okay.
But it's going against that business. It's not you. It's against that business.
Okay.
And the important thing is you're setting up trade lines against that business.
Got it. But what about conventional credit cards that are, you know, branded by Visa or MasterCard? So when you're opening up one of those credit cards, you're guaranteeing by yourself that
Depends on the card. It's a great question. It depends on the card. So we're in the final stages of getting a deal with Capital One. And Capital One has like their Spark Classic card. Their Spark Classic card will report against your business. Their other Spark cards will report against you personally. So that's something that they often don't talk about, but it's something you ought to consider.
Where can I get a list of the credit cards that?
We're working on it.
Okay.
We are literally working on it.
All right.
Exactly that. So exactly, you're going to come in and like, which are the ones that are going to report to your business? But I can tell you right now, I think it's Capital One Spark Classic
Okay.
will report against your business as opposed to you personally.
Okay. Thanks.
All this stuff we've already talked about. Get that business bank account. Charge as much as you can to your business as opposed to your personal. As soon as you can, get QuickBooks Online, business insurance also, and start building that business credit. So these are some basics and I can send you guys all of this. Check regularly. No thin files. If you show up and it turns out that they've got nothing on you, figure out what you got to do to build it up. Make sure you got at least 4 credit lines reporting against that business, even if you have to go to Chevron, Shell, and Home Depot to sign up for these $100 cards.
So reporting to Experian.
Those will be reporting most likely to Experian. No, I'm sorry, to D&B. D&B requires 4 lines.
So DNB, that's a good question, because DNB tells me that they only accept reports from those that have DNB number and work with them.
Yeah.
So in my case, my vendors do not work with them, so we have 0 reports.
Yes, but you can request your vendors to report to D&B.
But they're not DNB members, they cannot report. So you're saying that credit cards from Home Depot, I can go open credit cards?
They usually do. They usually do. But to her point, DUNS number. On our service, you can get a DUNS number for free.
I can, but they don't.
That's true. But I'm just saying to your point, anyone in here, if you want to get a DUNS number, you can do it for free on our site. So at least DUNS knows who you are. And then we will also tell you, if you sign up, who's reporting back.
In regards to the accounting software, we are a small business that we actually use QuickBooks Online.
Mhm.
But I wanted to ask you in regards to how serious it can be seen, as you mentioned that they use the tax returns at some point. So maybe you think that small businesses that are growing should change to another type of software?
No, I can tell you confidentially, sort of, that QuickBooks believes that they can determine risk better than a traditional underwriter based on your QuickBooks file. They're testing that out right now. I can tell you that a bank's not going to look at it that way. Okay. That being said, the more you know about your business, the better off you are. So if you've got QuickBooks Online, another product I would encourage you to look at is called LivePlan from Palo Alto Software, which is business planning software. I get no money for saying that. I'm just giving you that heads up. If you have a small business and you want to get a traditional small business loan, when you go into that lender, the better prepared and more knowledgeable you are, the better. So if you go in, this is my personal score. These are my business scores. This is my Experian and D&B scores, which we can give to you. Or, God willing, you've got a great SPSS liquid credit score. This is my score. I have QuickBooks. This is my average daily balance, blah, blah, blah. The more that you can show the banks that you're on top of your business and it's a going concern, the better off that you'll be. Good. And I think that's it. That's why we created Creditera. I'm not going to bore you with the product anymore, but
Thank you.
that's why I'm here. One more question.
Yeah, going back to the fact that most of us here are in startup, can you address that segment of people who are in need of loans and how we can access those loans for
Sure.
businesses?
So I don't mean to be a Debbie Downer, but if you're in a classic startup, getting a loan is going to be almost impossible. And by that I mean if you have a product that is a classic consumer product that we've developed, right? Banks don't like risk, or they don't like serious risk. All of them have to take some amount of risk, right? A typical venture company, they're going to lose 20 out of 1, right? So they hope they're going to make 20 bets. They hope that 1 pays off. A bank's going to make 20 bets, and they plan that 19 are going to pay off, right? They have a very different profile. So, but on the flip side, when you go into that venture firm, you have to show them that that 20 out of 1 risk isn't going to pay back 100%. It's going to pay like 1,000%. It's like, this is a huge market. I understand this. Nobody's done this before. Nobody's quite done it like this. You have to paint the vision for why this is huge. This is a $1 billion opportunity. Now the good news is you live where it happens, okay? If we were all in Topeka, we'd all be screwed for the most part if we were venture companies, right? Because we don't have access to that kind of capital. The good news is we all can get on 101 and we can be there in 20 minutes for all of those big companies. But you have to show them that vision, and you have to paint a very credible vision of the future about how you can create that $1 billion industry. If you can't do that, or if your business isn't that kind of business, right, which is fine, it's a florist, it's a restaurant, it's whatever, at that point you have to show really solid fundamentals. You know, this is a profitable business. I am experienced. I've done this 3 or 4 different times, and I'm going to show you how I've done it before. I need $100,000, and let me show you down to the last penny how I'm going to invest that and how that's going to return on your capital and why that's a safe bet. Okay? Those are 2 completely different conversations. So I have Kim, I have no idea what it is that you're interested in, but they're 2 very different conversations.
So does your service propose which banks are quote unquote small business friendly than others?
Yeah,
more
ultimately,
lenient than
I think
others?
that's where we would like to get. Right now what we do is when you come in, we'll help you figure out where within the landscape you would fit. And actually, I'll tell you what, I'll hand these out. So what we have here is your business finance options from a bank loan to online lenders, micro, merchant cash advance, and credit cards. And yeah, depending on what it is that you're looking to do, your credit report, the amount of money you want to pay, run out of those. That'll put you kind of within that scope. And I am sorry, but I think that's all of them. I guess I got a bunch of these. Well, if nothing else, here you go, all this. Any other questions? That I don't, but it's on our website. And actually, if you go to our website, what we have here, actually, this is just a high level. And if you just go to our website for free, you don't even have to sign up. You can drill into this. So, and it goes 3 levels deep. So if you want to say online lenders, you can go all the way through, and we'll tell you the pros and cons for each different kind of lending option.
Do you speak about the interest rates and all that?
High level, I mean, like I said, what we have here is there's a variety of different APRs. We recently acquired a company, and so in the next few months, we're going to launch some tools where you can go in, depending on whether it's a bank loan or a merchant cash advance or whatever, you can put in the amount of money that you want to get and the payment terms back, and we'll tell you exactly how much you're going to be paying for that money. A lot of people think of APR. APR, I mean, let's face it, Americans aren't great at math and statistics. So what we wanted to do with these calculators is tell you actually in dollar terms how much money you're paying for this money, as opposed to giving you an APR, and that's what we're going to be launching in the next few months.
So in difference to separating business from personal credit,
yes,
I would like to refer to a situation where a key person, rainmaker, is in the company. So he's assumed this is the guy who is bringing in all the sales. And the other guy is manufacturing and delivering and things like that. And if this company makes a loan out of a company, bank sees him as a key person. And if this person dies, for example, banks or sometimes demands the return of capital. Right, so that can happen in a small business situation or even growth company. So how can they separate that kind of situation between business and personal?
Well, that's a tough one. So if I could repeat that back, you're saying that some business has a rainmaker who's associated and who can kind of bring in all of that capital. Now, I'm guessing that that's a case where your local bankers know that individual, and they know that individual, Joe, is associated with the business, and therefore they're banking on him because he's associated with that business. Boy, I don't know. I don't know how to give you an answer to that one. That to me seems like a very local type of banking issue, and I have no idea how that would be addressed generally. But I totally get the point.
Okay. Thank you.
Other than ensure that your business has solid business credit, so if you have to move to a bank that doesn't know Joe, you're good.
Even a large company, large tech company.
Yeah.
That company has a tech star, which has architected the product or whatever.
Yeah.
He leaves, the company valuation plunges, right?
Yeah.
So that can happen.
Okay.
Perhaps a little out of perhaps a little out of context, but does your business credit score in any shape or form impact your insurance quotes?
Mm-hmm. So that's actually a very good question. And I say that because I've had a hard time getting to the answer to that. So I can tell you that our founder believes so, which is like your business credit score is going to impact your insurance. But I'm just totally transparent, I have gone to Nationwide and farmers and those guys and have said, do you guys pull credit scores? And they say that they don't. But when I talk to small businesses, they know that when they get business insurance, it turns out that their credit has been pulled as an inquiry. So, and I just say that because I've literally gone to insurance companies and asked to talk to underwriters and they say no. And then I've talked to small businesses who've gotten insurance who have told me within a year or within a month of them getting insurance, their credit has been pulled. So the evidence seems to suggest that they pull it at some level, but I just don't know exactly how. But I mean, to your point, I have literally tried to uncover that and I haven't been able to get to it.
So we have a bank account, and I was wondering if getting a credit card versus a debit card would make any difference on that bank account.
So definitely get a credit card because a credit card's going to report to the credit bureaus because it's credit. Debit is going to be your personal information. It's not going to report to a card. So, one of the most important things is I know I grew up this way, and certainly our founder, which is like credit is bad, don't take any credit. And then you grow up and you realize that having no credit is almost as bad as having bad credit, right? So taking out some credit, particularly as a small business, is a really smart thing to do. So if you are new to business, whatever your business might be, I would strongly encourage you to take that credit card and not a debit card to get that trade line reporting. But I would also be very proactive to determine where is that trade line reporting to. Is it reporting to you personally or to that business? You want to report it to the business, not to you as a personal guarantee. KFC.
Does checking your credit score often or not affecting your score, or somebody checking or yourself checking, is there any difference?
So the question is does your checking account impact your credit score?
The credit score. If you check your credit score often or not.
No. So that's a very good question. So there's a difference between something called a soft pull and a hard pull. If you look up your personal credit score, it's called a soft pull. You can look up your credit score as much as you want. It will not count as an inquiry against you. A hard pull is when an agency is going to pull your credit score for the purposes of determining your credit worthiness. Okay? So if you sign up for our product, Credit Karma, Credit Sesame, any of these, those are soft pulls. It is not going to go against your credit report. That being said, a lot of people kind of worry about the inquiry piece. It's only about 15% of your score. Far and away, far and away, the most important aspect of your credit report, personal and business, are your payments. Do you pay on time? Okay? It's over 50% on the business side. It's about 35% on the personal side. The next major component is your credit utilization. If you have a $10,000 credit card, are you running, it up past $3,000 or $4,000? I'll give you one more little trick that I learned, surprisingly, after I joined the company, which is how credit companies determine your credit utilization. And that is, so I never carry a balance on my credit card, right? But I put everything on my credit card to get miles. I got a Capital One miles account. I haven't paid for a flight home in 10 years, right? But I noticed that I had good credit, but not outstanding credit. And I looked on our service and it said the ding against me was I had high credit utilization, which was I was using a big chunk of my credit card, right? And so like 35%, because I had a Capital One card with a $15,000 limit, and it was showing me every month I had about $5K on it. And so I realized that, well, yeah, I had about $5K on it every month, but I paid it off every month. But then as I looked at it, I realized that the credit companies were pulling my credit report at the end of the month. And my due date for Capital One was the 4th of the month, right? So they were looking at it like at 28/30, and I was paying it off 4 or 5 days later, right? Completely wiping it out. So what did I do? I called Capital One and I said, I want a new payment date. Give it to me 2 weeks earlier, right? So now I pay in the middle of the month. The next month, I come in, I pay my thing off exactly as I did. My personal credit score went up 40 points. Why? Because all of a sudden, I got 15% credit utilization because they're checking me at the end of the month after I just paid it off 2 weeks earlier.
How do you know when they're checking? Do they always check it?
Well, you check your credit report and it'll tell you what's your credit utilization. If you pay it off every month,
How do you know when they're checking? How do you know they're checking at the end of the month?
well, you're going to be able to tell by what they're telling your credit utilization is. You see what I'm saying? Right? So,
It's on the statement each month.
yeah.
The month ends.
But the most important, like if you sign up for us or Credit Karma or whatever, you can go in and say, what's my credit utilization? And if they say it's 35%, right, and you have a $15,000 credit limit and you're saying $5,000 and you're paying it, that means they're hitting you right before you pay it.
Okay, so you're back engineering it.
You just back engineer it. Yeah, exactly. Because they only look at it once a month.
I thought that credit card companies report your balances, high balances to the credit bureaus.
Well, no, the credit bureaus are going to go and check and see what your balances are once a month. And if it's high, it's high. They're not going to report it back. They're reporting on you generally. It's not an ongoing thing. The credit bureaus are going to pull that report once a month.
Isn't the credit card companies reporting your credit to the bureau?
Yeah.
I didn't realize that the credit card companies are API pulling from banks. From the credit, I mean, the bureaus are not doing an API pull from credit.
Well, whatever it is, the bureaus are looking at, they're getting that number once a month.
Okay.
So they're not doing it daily, seeing what your balance is. They're looking at you once a month. And so it behooves you to figure out when are they looking at you, particularly if you pay it off.
So if you have 3 credit cards, let's say 10,000, 10,000, 10,000, you don't have to go above 35% of the 10,000 or the total 30,000.
It's going to be for
let's say.
each.
For each.
For each.
So You mentioned earlier that as much as possible, don't be late with your payment. Now, there are times when...
On the business side.
On the business side, yes. But however, there are times when, money is, and sometimes we get late, no? So how often do you get late to make it drastically affect your credit? And how do you repair that?
Well, let me just say this. On the business side, if you have to be late personally, not on your business side. Payments on your business are 50% of your score, and you're considered late 1 day late. Just once? 1 day after the due date, you're considered late. On your personal score, you can be up to 30 days late before you're considered late. Okay? So on the business side, do your best to pay ahead of time or on time as much as you can on business. If you're late more than 90 days, that's on your record for 7 years.
So if I only did it once?
No, well, not 1 day, but yeah, if you're late more than 90 days once.
One occurrence. Let's say I only was late for one time, and then succeedingly everything was okay.
But how late were you on that one?
Let's say I don't know, 5 days, 10 days. It doesn't matter.
You'll be fine.
Okay.
But I'm saying if you're, one time I was late 90 days.
Okay.
That's going to be on your record for 7 years.
You can't repair that at all?
It's on your record for 7 years. I didn't make the rules, by the way. Don't.
So you mentioned about the small SBA loan.
Yeah.
And that it, to be eligible, you mentioned that it takes several years to be eligible to build the credit. So can you elaborate on that again a little bit?
So the SBSS Liquid Credit Score is provided by FICO. We have the one created by a combination of Experian Personal and Business. It is a quick judge or filter or gateway, depending how you want to look at it, for your eligibility for the SBA loan. So a personal plug for our product. You can't get it from your bank. You can't get it from the SBA. You can basically only get it from us. It took us 2 years of negotiation to do it. It's $50 to get it. But if your business has been around for a while and you have pretty good personal credit, I would highly encourage you to pull it, because if you have over a 160 and particularly over a 180, and we'll also tell you instantly whether your business would qualify based on your revenue, your industry, and some other components. And if you qualify for that, you print that out, you go into any local bank and say, I got a 200 SBSS Liquid Credit Score, here's my business plan, you're in really good shape, and that's the best financing you can get.
Thank you.
I think SBA loan can be based on asset lending or cash flow lending.
Mm-hmm.
And in this situation, probably we are looking at mostly cash flow data from all the bureaus, but how can they pull asset data?
So they would not pull cash flow data. They would once you got in. So let's just say you go to On Deck or Merchant Cash and Capital. What they claim is that they are less concerned about your credit scores, but then they're going to want to get your banking data, and then you have to provide them your cash flow data. So cash flow loans, workflow loans, they're going to want to see your bank accounts. Good. I think we're out of time.
Okay.
Well, thank you guys so much. Great questions.